The U.S. economy has been showing strong signs of growth, and this momentum is most visible in the latest GDP numbers, job creation, and consumer spending patterns. Gross domestic product, which is the broadest measure of economic activity, has expanded at a pace stronger than many analysts had anticipated, signaling resilience despite global challenges. One of the main contributors to this growth has been the labor market. Employers across industries are hiring at a steady rate, unemployment has fallen to near record lows, and job openings remain abundant. This means more Americans are back at work, which naturally boosts household incomes and confidence. Alongside this, consumer spending, the backbone of the U.S. economy, has remained robust. People are shopping, traveling, and dining out more, which further stimulates growth in retail, hospitality, and services. The rebound also reflects pent-up demand after years of uncertainty during the pandemic, when many households saved money or delayed big purchases. Now, with improved job security, families feel more comfortable spending again. Businesses are also benefiting from this increased activity, leading to higher revenues and expansions. Together, these factors create a cycle of growth where strong demand leads to more production, more hiring, and greater economic activity overall. While challenges remain, such as inflationary pressures, the current trajectory shows that the U.S. economy is bouncing back with surprising strength, giving policymakers and everyday Americans cautious optimism about the near-term future. Several key factors are driving the rebound of the U.S. economy, and together they paint a picture of resilience and renewed optimism. One of the most important contributors is rising wages. As businesses compete for workers in a tight labor market, many have been forced to increase pay and benefits, which puts more money directly into the hands of consumers. When people have higher incomes, they tend to spend more on goods and services, fueling economic activity. Another powerful driver is government investment, particularly in areas such as infrastructure, clean energy, and technology. These projects not only create jobs but also lay the foundation for long-term growth by improving transportation networks, modernizing utilities, and supporting innovation. On top of this, corporate earnings have been generally strong, as many businesses have adapted to post-pandemic realities and found ways to operate more efficiently. Investors have responded with renewed confidence, pushing stock markets higher and increasing overall wealth for households that hold retirement accounts or other investments. Consumer confidence is also playing a crucial role. After years of uncertainty, many Americans feel more secure about their financial futures, which encourages them to make larger purchases, travel more, and invest in housing. This sense of optimism creates a ripple effect across industries, from retail to real estate. Taken together, these drivers form a powerful engine for recovery. While not every sector is rebounding at the same pace, the combination of higher wages, government spending, business strength, and consumer optimism is keeping the economy on an upward track. Inflation has once again become a pressing issue in the United States, and it's beginning to weigh heavily on households despite the broader economic rebound. Prices for essential goods and services are climbing steadily, creating a squeeze on purchasing power for millions of families. Food costs, for example, have risen due to higher production expenses, global supply disruptions, and increased demand. Groceries that once seemed affordable are now straining weekly budgets. Housing costs are also a major concern, with both rents and home prices elevated, making it harder for many Americans to secure affordable living arrangements. Energy prices, including gas and electricity, have fluctuated but remain higher than in previous years, adding another layer of pressure. While supply chain problems have improved compared to the pandemic years, demand in many sectors continues to outpace supply, which pushes prices higher. Another factor fueling inflation is the strong labor market, where rising wages, though beneficial for workers, contribute to higher costs for businesses, which are often passed on to consumers in the form of higher prices. This cycle makes it difficult for households to fully benefit from wage gains because their increased income doesn't stretch as far. Inflation also impacts savings as the value of money erodes over time, and even modest increases in everyday expenses can add up significantly. For families already struggling with tight budgets, this resurgence in inflation is particularly painful, highlighting the challenges of enjoying the benefits of economic growth while dealing with rising living costs. Federal Reserve plays a central role in addressing inflation, and its actions have a direct impact on both the economy and the daily lives of Americans. To combat rising prices, the Fed has been steadily increasing interest rates. This strategy is meant to slow down spending and borrowing by making credit more expensive. For example, higher interest rates translate into more costly mortgages, auto loans, and credit card debt. Businesses also feel the effects, as borrowing for expansion, equipment, or hiring becomes less affordable. By cooling down demand, the Fed aims to ease the upward pressure on prices and bring inflation back under control. However, this balancing act is delicate because tightening monetary policy too aggressively can slow growth or even push the economy into recession. At the same time, if rates are not raised enough, inflation may persist and erode purchasing power. The Fed is essentially walking a tightrope between stabilizing prices and maintaining healthy levels of employment and growth. These policies also influence investor confidence and stock markets, since changes in interest rates can affect company profits, bond yields, and overall economic outlook. For households, the effects are mixed. Savers may benefit from higher returns on deposits, but borrowers face higher costs. The challenge lies in finding the sweet spot where inflation is reduced without stalling economic momentum. The Fed's decisions in the coming months will be crucial in shaping whether the U.S. achieves a soft landing or faces more turbulence in its recovery. For everyday Americans, the current state of the economy is a mix of opportunity and challenge, reflecting both the strengths of the rebound and the strain of rising inflation. On one side, the job market is exceptionally strong, with unemployment at historically low levels and many companies still hiring across sectors. This creates a sense of security for workers and opens doors for career advancement, higher wages, and better benefits. Many families are seeing more opportunities to improve their financial situations through new employment or additional income streams. However, the other side of the picture is far less encouraging. Inflation continues to erode purchasing power, meaning that even though people are earning more, their money doesn't stretch as far as it once did. Groceries, housing, transportation, and healthcare costs are consuming a larger share of household budgets. For lower and middle-income families in particular, this makes it harder to save, invest, or plan for long-term goals such as education or retirement. Higher interest rates also affect big financial decisions, from buying a home to financing a car, leaving many hesitant to borrow or take on new debt. As a result, the benefits of a strong job market are tempered by the frustration of rising costs and financial pressures. For many Americans, the rebound feels real but incomplete. While opportunities exist, the cost of living continues to challenge financial stability. This tension between growth and affordability defines how most households are experiencing the economy today.